So I've been getting a lot of questions about student loans and the difference between the HEROES Act and the HEALS Act. So I thought I'd break down the key differences in these two different stimulus programs and what they mean for you. So let's do first the HEROES Act. That is the $3.5 trillion bill that was passed by the Democrats back in May. As part of the HEROES bill, there would be an extension of the CARES Act student loan non-payment, which was for until September the 30th. So you wouldn't have to make a payment until September the 30th. There would be zero interest on those payments. And there would be a $10,000 reduction for people who were economically distressed during this time. They're estimating that's 20 million people with student loans would get a $10,000 reduction on their student loans. I think that's a very, very generous plan and would give people a lot of breathing space. Now, the HEALS Act. They would have, this is post September the 30th, they would have no payments if you were earning no discretionary income. And they class discretionary income as 150% of the federal poverty line, which comes out to $19,120. So if you earn $19,120 and you are single, you would not have to make any repayments. And then once you go above that, you have to pay 10% of your discretionary income, or 10% above that $19,120. Again, that's not a bad plan. It doesn't really help a lot of people. Again, I feel like sometimes these stimulus programs and these social security programs don't really help the folks in the middle. But at the moment, as it stands, there's been no agreement on any of this. So we're looking at September the 30th as the cutoff, as the deadline for when you would have to start making payments again. So while I'm at it, I thought I'd talk about your options in case we don't get an extension of the blanket forbearance after September the 30th. So there's a couple of programs that you might be able to be a part of. So I'm going to go through them. There's actually 4 different things you can do. The number one thing, and these are mainly just for federal student loans, so make sure you haven't, these aren't the private ones. These are through the federally funded student loan programs. Just make sure you know which ones you have. But there's straight up income driven. And this is where it is pegged to your income and you only pay a certain portion of your income towards student loans. It's designed so that you can scale up as your income increases. You can scale up your repayments back to this institution. The big downside of this one is you still accrue interest on the principal. So say you have a $20,000 student loan and you're only paying back $500 a year. You're still paying full interest at an annualized rate on that $20,000 principal. So you're going to pay more interest over the life of the loan. Whereas if you had been making like large monthly repayments, you would chip down that interest, so that principal, so you wouldn't pay as much interest. The second one is, forgiveness for certain professions. So there's a teacher student loans, or there's the public service loan. That's where if you are working in public service, specific public service, so usually government jobs, and you make 120 payments, they will forgive the rest of the loan. It's really hard to take advantage of this, but if you can, and you do qualify for that, that's something to look into if you're thinking about taking that government job that doesn't pay as much as the private sector. That's something to weigh. There's also deferment versus forbearance. So the big difference there is, and these are only again with federal loans, deferment is when you don't have to make payments because of your income, but interest still accrues. And then forbearance is you don't have to make payments, but interest is stopped. So that's the big deal about these bills that are going through now. It's all forbearance. So interest is not being accrued while you're not making these payments. That's a big deal because you don't want to get stuck with a check for all the interest that you've had to pay over the last 6 months at the end of this. And then the last thing you can do is refinance. Now, refinancing means that you go to a different lender, they buy up your debt, package it all together, and typically give you a lower rate of interest. The problem with refinancing is you lose all those federal protections. So typically you can't do income driven, you don't qualify for the public service loan forgiveness or the student teacher loan forgiveness or forbearance or deferment. Now, a lot of these private lenders do have their own programs around this, but you are, you know, you're going to have to negotiate that on an individual level. None of these statutes that they're passing through Congress right now will apply to private loans. So they're your options. I'm going to leave a really helpful link below with all of this information. I think you should definitely look into this if you have student loans and you're worried about post September the 30th. There's a lot of other programs, and I'll do another video about the different ways you can handle your credit card debt or any other kind of debt you might have around this time. A lot of the lenders are being very, very generous. You just have to be very careful because it can sometimes impact your credit score. So just be careful around that. Okay, thank you so much. Leave a comment. Let me know any questions. Like and subscribe. I'm going to have more of this, more in-depth analysis of the different parts of these two programs coming up. So stay tuned. Thank you so much. Good luck, and I'll see you in the next one. Thanks. Bye.
And it's a ticket talking Mazda for the biggest. That's a comma and a comma and a comma, gotta get it. I'm a comma and a comma and a comma, gotta get it, get it, get it, get it. Comma and a comma, gotta get it, get it. And it's a ticket.